Welcome back to another episode of the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 114. On today's episode, a little bit of Halloween Scaries this week. We had earnings this past week from Google, Microsoft, Amazon. Some good, some bad. We have GDP growth. We have just not a lot of good news going on out there, and it's really hard to get excited about the stock market right now, investing. But we're going to do the best we can. And so let's discuss all of the things that are going on in the market right now and what could possibly turn it around. So get your mind right. Let's get to work. Well, as always, welcome back to the show, everybody. Another rough week in the stock market. I mean, these weeks are just reminiscent of 2022 here, just kind of giving back some of the yearly gains. And it's just not pretty. Not every week can be exciting. And these weeks are definitely just moving in the wrong direction. So let's just talk about a couple things that are out there, a couple things that are weighing heavy on the stock market as we're kind of deep in earnings here. And some companies not reporting bad earnings. They're not great earnings. The guidance is really kind of what, hits the market. Not really sure what's going to happen in the future for a lot of these companies. But you look at it, and so we'll kind of break it out here and just discuss some of the kind of important developments of this past week, and then some of the things that we can look for coming up and see what we really need to pay attention to. But I will say it all comes back to consistency, continuing to invest, continuing to do the things that we know are going to make us successful. And so even though the market isn't looking great and it's not fun to look at your account and have it go down all the time, you really have to kind of just hold your nose and basically do the things that got you here. So a couple things I wanted to point out. This past week, we had the GDP, gross domestic product number, come out, which is basically how fast is the U.S. economy growing. And it is growing pretty fast. So this past quarter was 4.9%. To put that into context, the expectation was 3.8%. And last quarter, growth was 2.1%. So you have the economy growing faster than we expect, which means that the Federal Reserve is not going to lower interest rates anytime soon. There's debate on whether they're going to raise interest rates. This coming week, they have a meeting. They talked about maybe raising rates one more time this year. With all the global conflicts going on, the consensus is that they will not raise rates. They will hold them steady and kind of basically play the wait and see game. They meet, like I said, this week in November, and they have one more meeting for December. So we'll see what they do. But the consumer seems to be remaining strong, even though there's a lot of kind of warning signals that the economy or the consumer could break down at any moment. And so you look at just kind of some statistics here that I looked up before starting this show. And, U.S. savings rates are very low. The average American is saving about 3.9% of their salaries, which is very low. 81% of Americans in a poll said that they haven't saved anything in 2023. Nothing, have not saved anything. For the first time in history, we've had credit card debt go above $1 trillion, which is just amazing, right? $1 trillion in credit card debt. So Americans, we are good at a lot of things. Delayed gratification is not something that we would ever be ranked very highly on. I can assure you of that. And so you look at these things going on out there, and you look as an investor and you say, man, what can I do? Where is there a potential for me to be able to make some money here? And, there are short-term treasuries, there's CDs, there's bonds like we discussed last week. By the way, last week we discussed TINA, which is there is no alternative, and what you could do. I went back and looked for some bonds last week. I also referenced a paper done by, or a memo from Howard Marks. And so if you want to go look up one of the ETFs that he discussed, or one of the bond components he discusses, the symbol on that is USHY. So USHY, and that is the iShares Broad US High Yield Corporate Bond ETF, and the yield on that is currently 6.77%. Now, if you look at the chart on that, the 5-year chart, it's going to look ugly. And that's because last year and early this year, when the Fed was raising rates, the pricing of bonds is inverse of interest rates. So if interest rates go up, the existing prices of bonds goes down. If they start to lower interest rates, then the price of bonds is going to go up. So it's an inverse relationship. So when you look at a lot of these bond funds and you look at them over the last 5 years, they're going to be pretty ugly. And they're going to be pretty ugly because last year was the worst year for bonds in 100 years. So this is one of those times where looking back over a stock chart might not be that helpful. It really might not be that helpful. But going forward, it should be maybe a different story if we're getting close to the Fed having interest rates be where they want them to be. You know, if they were going to raise interest rates to 10, which I don't think they're going to do, so that's not a prediction. But if they were going to raise them that high, then right now would not be the time to buy. But if they were only going to raise, interest rates, maybe the highest would be 5.5 or 6, then this would be a good opportunity to buy in those. So just kind of a continuation of our discussion last week. I felt like I didn't do too good of a job kind of explaining that. I thought it was clunky. So I went back, wanted to get some more information for you, get a little bit better data. So USHY is one. Vanguard has some bond funds. But if that's something you're interested in, you can go look at those. But also, just talking about the credit card debt of these companies, if you go look at some of the top stock charts of, the big credit card companies out there, Visa, MasterCard, American Express. I mean, you go look at their stock charts. I mean, it's almost hard for them not to make money. It's almost hard for them not to make money. I mean, you just look, these are very well-run companies. It's really difficult for somebody to come into that space and challenge them. I mean, there's been some fintech companies that have come up, but they're still not to the same level as Visa, MasterCard, and American Express. And so, not that I'm trying to profit off of other people, but I'm just, you profit and you invest off of other people's habits. I mean, Americans are geared towards putting things on their credit card. They're paying these companies interest. They're carrying more credit card debt than ever. And so if you look at Visa, MasterCard, American Express, it's going to be hard for them not to make money again. And it is the way it's been. That's the way it's been like since credit cards came out, right? So, it's just one area. Just because different pieces of the market aren't good doesn't mean that there's not good companies within the market, and we just got to go find them, right? So when you look at defense companies, Lockheed Martin, Northrop Grumman, Raytheon Technologies, Palantir, some of the defense companies that are out there. Defense spending is not going to go away. That's worldwide. You look at all the, missiles being used, and unfortunately all the missiles and all the conflicts going on. Eventually, these countries around the world are going to have to resupply themselves. And when you look at the backlog of these companies, so you can go look at the backlog is how many orders do they have that they haven't fulfilled yet. And it's massive. For all of these companies, it's a massive, massive number. And so, you look around and then you look at the big tech companies that we've talked about this past week. You look at the earnings of Microsoft, which are incredibly impressive. You look at Google, which Google sold off hard, and their earnings really were not bad. Their advertisements down a little bit when you look at Google and you look at Meta. Their advertisements are down a little bit, and what they said is companies really don't like to advertise as much when there's global conflicts going on and those kind of things. So advertisers pull back a little bit, but nothing like worrisome in Google's quarter. And then you had Amazon at the end of the week. Amazon had a good quarter. Amazon Web Services, the amount of consumer goods that are being shipped. And, with Amazon, it's just amazing. They're going to hire like 200,000 elves to deliver Christmas this year. It's serious. They hire a lot of people to be able to ship all these packages around. And so the best companies are still going to be the best companies, even when times are not as good. And so you have to really look at the companies you've been wanting to invest in. Use this pullback as a period of time to be able to do that. One new company, well, it's not a new company, a new company to the show, but Waste Management, symbol WM, is one that I think you should put on your radar, look at. We've talked about how there's not a lot of people who are out there trying to revolutionize the waste management business. But listening to their quarter this week, it is pretty incredible what Waste Management has been able to do as far as efficiency for the company is concerned. When you look at technological advancements, and especially when it comes to investing, when you look at a technological advancement, you have to ask yourself as an investor, is this something that's going to flow through the company to the consumer, meaning that it makes the product, cheaper for the consumer, but it doesn't really make the company more money? Or is it something that the company can actually use to make themselves more efficient, make themselves more profitable, and then that actually helps as an investor because the stock price goes up? Well, with Waste Management, right, they're driving all these trucks around. A guy gets off the back of the truck, he picks up the trash can, he throws it in. Well, they've got some automation that's going on that is pretty incredible, where they don't need as many people on the trucks. They have an arm that comes out, grabs the trash can, picks it up, basically dumps the trash. And the CEO was saying that that job has a 50% turnover ratio, which I'm not sure we're really surprised by that, but 50% turnover ratio on that position. And so as those people have basically quit that position, they're doing these new trucks where they actually don't have to rehire those people, which is an incredible efficiency for the company. They're also using some of their landfills where they have methane gas and all these gases that they're able to capture, and they're basically using that to power the trucks that are driving around through the cities, picking up all the trash. So Waste Management doesn't sound like a technology company, but if you go look at them and you look at their stock chart, it is pretty amazing. 5 years ago, company right now is $160 a share. 5 years ago, it was $88. You go back to 2012, and it was $32 a share. And so Waste Management, it's a business that's not going away. It's a little bit more defensive, but they're using technology to actually improve their business, make them more cost effective. And that cost effectiveness is staying within the company, making the entire company more profitable. So there's businesses like that are out there that you can construct your portfolio around, and you can, look for, you can get some really solid companies. And so I want to draw your attention to when you hear about the S&P 500, the NASDAQ, the Dow Jones, you have to realize how much the same companies are in those indexes. So when you look at the S&P 500 by weighting, I'm doing this on the fly here, and you look at the top companies of the S&P 500, it's Apple, Microsoft, and this is in order: Apple, Microsoft, Amazon, NVIDIA, Google A share, Meta, Google B share. The top 7 companies are all the companies that you would think of. 8 is Berkshire Hathaway, 9 is Tesla. So then you go look at the NASDAQ holdings by weight. And the NASDAQ is Apple, Microsoft, Amazon, NVIDIA, Meta, Alphabet, Alphabet, Tesla. So these companies have gotten so big. My point is that these companies have gotten so big that they're the top of both of these indexes, right? So the S&P 500 and the NASDAQ. That's something for you to be aware of, because sometimes we're just putting money in those places and we feel like we're more diversified than we really are. So, if you're buying the S&P 500, don't feel like you automatically have to invest on top of that with individual stocks like Apple, with all these companies, because you own a lot of them already. Just in the Nasdaq, Apple is a 11% weighting, and in the S&P 500, it's a 7% weighting. So these companies are dominating, and they're very important. Apple reports this coming week. It's going to be very important to the market, what Apple's numbers are. It just is. It just is. So, as a intelligent investor, you just have to be aware of these things, because, again, sometimes we feel like we're more diversified than we are because we own indexes, or we own index funds or mutual funds or whatever. But really, when you look inside of them, you own the same companies over and over and over and over again. So if they get beat up, you get really beat up. You feel the pain more than most. So checking these out, making sure that you're paying attention to that is key. And so then look for kind of some of these other companies, Waste Management, just different kind of solid, stable companies that are out there. But in order to get, for this to calm down, we need unemployment rate to go up. This is the sad thing is for the market to kind of have the clouds clear, have this overhang go away. We need bad things to happen, which is not a good way. Most of us don't like thinking about bad things having to happen, where the unemployment rate needs to go up. You need the economy to slow down. You need just all of these things to just start to slow, so the Federal Reserve can go, okay, inflation isn't going to go up. We can actually stop raising rates here, or we can stop threatening to raise rates. Because even them just saying we're going to raise rates and then they don't, that puts a damper on the economy, because it allows, like, just the expectation that they're going to do it allows everybody to kind of take a step back. But there it's just kind of a wait and see period. It's just a wait and see period. And again, you have to return to your watch list, look at the companies you've wanted to invest in. One of the main ones I get questions about would be NVIDIA. And so NVIDIA doesn't report for a while, but NVIDIA is down to $405 a share. And they were at 500 back in late August, early September. And so NVIDIA is down based on the fact that the U.S. government's not going to allow them to sell as many chips to China, or specific chips to China. But when you listen to the conference calls of the companies that have reported, Tesla, Microsoft, Google, Amazon, they are all buying NVIDIA chips as fast as they can make them. And so I know it's a negative that they can't sell to China. Well, I mean, whatever. It's not. It kind of is a headline risk that they can't sell to China. But I'm not even sure it matters. Like, I'm sitting here going, okay, well, if they can't sell to China, I'm pretty sure. Like, can these other companies, can they make up that demand? Can these other 4 or 5 companies that are buying these chips, can they make up that demand? Because in order for Microsoft, Google, Amazon, for them to meet their strategic goals over the next year that they've set for themselves, AI is a big piece of that, and they have to have NVIDIA's chips in order to make that work. So NVIDIA is in a very good spot where all of these other companies, their goals are based on their product. That is a very good place to be if you're a company looking towards your future and the ability to take advantage of that. NVIDIA is in a very good spot. So go look at some of the companies that have been beat up, that have been on your watch list, and think about being better than average. When you look at average American hasn't saved any money. Average American hasn't invested anything. Average person is saving 3.9%. I mean, that is, for every $100 they make, they're putting back $3.90. And that's basically only a small portion. I mean, you look at the 80% haven't saved money. That's how most things, that's how most things work out, right? If you've ever been in my class, we talk about all that. We talk about this all the time, the 80-20 rule. 80% of the work is done by 20% of the people. You've been in a group project before. You've worked for a company where 20% of the people do 80% of the work. So seeing that 80% of people don't save and 20% do save, I mean, it doesn't sound good, but it's really not that surprising because that's how most things work out. So around here, we're better than average. We're way above average. We invest in ourselves, mentally, physically, financially. We're doing the things that we need to do to take care of ourselves so that we can have a different future than everybody else. And so keep that in mind. Even when times are tough, we just think about those things. We have our habits. We're consistent. We stay on track and we keep moving forward. So I hope this has been helpful for you. I appreciate you. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.